Hey traders, welcome to Charts and Coffee. Hope everyone is doing well on this day after the FOMC. The last few FOMCs, there's been some interesting things that I've noted, and I'm sure a lot of you have noticed this too. Of course, we're going to see the volatility after the initial statement, and a lot of times the bigger moves are coming in the wake of the press conference, the presser. And then the day after, everyone has a chance to sort of fully digest whatever has happened, what the expectations are for July, etc. And then Monday morning ends up being another fairly volatile event. And I found that whatever swings that I might be interested in on Wednesday afternoon, oftentimes I'm going to get a second chance or even a better chance the next session, the next day, rather than having to force the trades on Wednesday afternoon. So we're going to definitely be keeping an eye on all that. The big question is now, now that we've publicly seen the Federal Reserve kick the can to July, they said, hey, we've got X months of data or X weeks of data to make a decision about whether or not to hike a quarter point. You know that if the jobs are steady, you know that if initial claims don't start to spike, they are. And if we look at PPI and CPI and PCE, if those are flat to cooler, they will hike. They will hike. They will take that opportunity to. So that's what we're watching all together, right? Collectively, we continue to watch that. But let's not forget, gang, when we step back and look at tech and we look under the hood of tech as well, NASDAQ, technology sector, communication sector, consumer discretionary sector, they are up, right? The big six, if you want to call it the big seven, they are up. Apple, Microsoft, Meta, the Googles, Amazon, Tesla, Nvidia, they are up. And I was on Benzinga yesterday. I don't know if I mentioned that yesterday when we were talking about market breadth. And as I, one of our inside jokes is market bad breath. That's an inside joke we have inside the Sector Secrets Mastery. I don't care about market breadth, right? We don't. Why don't we care? Whoa, Rog, heresy. Why don't we care about market breadth? Because the indices are not equally weighted. I don't care about equal weighted indices, right? The world that we trade is the world of high concentration weighted, where a few dozen stocks, gang, and I think you all know this, a few dozen stocks can move the broader averages. We don't need full participation. The S&P, the Dow, the NASDAQ, and even for those of you watching the Russell, what's up with the Russell all of a sudden? Gang, KRE, regional banks woke up. That allows the Russell to move. So a small number of stocks, a small number of sectors have a disproportionate influence over the broader averages. Please keep that in mind and don't get suckered into, well, we need market breadth. No, we don't, right? No, we don't. So it's great if we have it. Don't get me wrong, right? It just gives us as traders more opportunity, of a bigger pipeline, more names on our watch list, more margin for error. And we get all sorts of great things when more things participate. But the initial rising tide is going to be focused on a small number of stocks and sectors. All right. So with that being said, let's go ahead and jump into the questions. And I am using our Trading View chart. So let's open those things up. Here we go. All right. Let's get to it. Oh, hey, before I get too far ahead of myself, really important update over at countdowntrader.com. So if you haven't checked it out yet, I know it's not a sexy topic, gang. Whenever I talk about position management, risk, stop losses, how to lose well, I know that part of our brain goes click. We want to hear about new indicators and shiny new secret squiggles and wins, and all that's great. But I will tell you this, gang, at the end of the day, the reason we can come back and trade session after session, the reason we don't have to quit the game, hang up our cleats, is because we have good risk management. Listen to me now, believe me later, gang. I know it doesn't seem like a sexy topic, but this is the key, right? Playing probabilities and on the risk side too. So check that out. great update from Trish. This has been something that in the mastery and also in the futures room, she said, hey, Rog, it's summertime. It's time to start talking about the things that are going to set us up well for the rest of summer, but also into the fall trading season. And I'd have to say that's the most important one. So if you haven't yet had a chance, countdowntrader.com. That's my blog. It's totally free. And that's the current update. All right. So check it out. She nailed it with that one. All right. Let's get to it. So first up is, and we do have some hot zones to contend with. We have some data, if you will, not data, but events. If you take a look at the economic calendar, I'm on forexfactory.com. Scroll on down to Thursday, the 15th. The refi rate, core retail sales, Empire State Manufacturing, unemployment claims, all of those are already in the rearview mirror. So we're dealing with what has happened in the wake of those, the aftermath, Philly Fed. But probably the biggest one, gang, is ECB. Right after the FOMC, the next most important central bank to watch is a European central bank. And then after that one is actually the Bank of Canada for the markets in the US. 9:15, we have a quirky little hot zone then, industrial production. And then we move on to business inventories at 10 o'clock, which really should not be a big market mover. And then natty gas, for those of you that have been day trading that, NG futures, UNG ETF, natty gas storage numbers at 10:30 Eastern. So we're going to be dealing with a lot of data and central bank speak going into the open. So take a look at your trends and see what kind of mood the market's in before the bell. Maybe we'll do a little bit of that here this morning. All right, so let's see here. Looking at the first question of the morning, Amazon, sure, megawatt. All right, one of our big seven, if you will. Gorgeous uptrend. This is when consumer discretionary finally crossed the threshold, crossed the equator, started moving higher through the 200 propulsion. As far as a daily swing goes, so a swing to me is synonymous with buy the dip, right? What are the criteria? What's the sequence needed? What are the boxes we need to check to do that? Do we have a trend? Check, right? Do we have a pullback? Not quite. What would that pullback be? 34 EMA wave for me, that's my reversion to the mean, the 34 period exponential moving average. And or you can see beautifully the daily price movement range on the lower, say, third is overlapping. So I need to move at least to about 120, 130 for a daily time frame. Now, that doesn't mean I may not be able to have a separate type of setup on the 60, or that I may not even be able to day trade it. But when it comes to the daily time frame, because of the size of a daily candle and sort of the pace of a daily candle, they need to move more to pull back. The trades will take longer to form, but they should also last a little bit longer too, as compared to, say, an hourly time frame, right? So that's what I've got in focus there, Megawatt. Thanks for the question on Amazon. And then keep an eye, by the way, relatedly, Megawatt, on XLY. All right. Next up, what currencies have piqued my interest lately? Canadian dollar, I'd say, would be one of them. The Canada, the loonie, as it's known. And but mostly it's been the same too. And really it's really one. Now it's the euro, because the euro is the best way to play the dollar via 6E, and the euro is the best way, obviously, to play the euro itself. But I've been looking at Canadian dollar. Actually, I take that back. Another one that's been on the radar is the Aussie. Aussie's been on my radar a bit, but mostly it's been a desire to be long and stay long the euro, because long the euro acknowledges that the European Central Bank is still in their hawkish cycle. They're not anywhere near the end like the US Central Bank is. And a long in the euro is, in fact, a short in the dollar, because these have a 90+% negative or inverse correlation. If one ticks up, the other ticks down. So really the euro. And that reminds me, I've been getting a lot of requests to do a little bit. Hey, Rog, I know Forex isn't something we do here, but I know you've been doing that for 20 plus years. This is true. And a lot of folks are interested in currencies and all the ramifications that currencies tend to, right? Obviously. Monday, right? Is it this Monday? For about an hour in the Sector Secrets Mastery Room and in the Simpler Futures Room, we're going to do about an hour breakdown, just an hour explainer, about an hour of currencies. I'll talk a little bit about Forex. I'll talk a little bit about the central banks and also the futures currencies, which, by the way, the CME daily turnover is about $250 million per day. I know that's far, far less than what happens in Forex, which is 3, 4, 5 trillion per day. But ultimately, what we want to remember is that if we're looking at currencies, there's lots of liquid places to do it, and the futures are a really great place to trade on exchange, and whatever is happening on, say, Euro versus US will play out on 6E futures and even FXE ETF options. So we'll be doing that for about an hour after Charts and Coffee on Monday. Yes, the markets are closed for Monday. However, you guys know I'll do Charts and Coffee pretty much any trading day, and the Forex markets are open, so it'll be a cool time to do that. So if you're a member of the Sector Secrets Mastery or the Futures Room, tune on in. We'll probably go 9:30 to 10:30 on that, just right after Charts and Coffee. All right, so that's what's been on my mind, mostly 6E. Yeah, mostly 6E, Mel. All right, Michael, please review Adobe. Sure. Adobe on the daily time frame, uptrend. Obviously, this is something we need to keep an eye on right there, right? So anytime I'm this close, right, anytime I'm this close to an earnings event, the scales shift towards traders who write premium. I am not one of those traders. That's not my typical mode. I like directional debits. That works fantastic for me. As we get closer to an event like this, implied volatility goes up. Obviously, post-event, vol crush is a real thing. And so what I like to do in a situation like this is let the event happen, and then I'll trade the aftermath. So if you're looking to write premium or anything like that, Michael, that's definitely not going to be within my power band. It's not the way that I usually look at the market. However, if after earnings we get a pullback, whether it's a gap close, whether it's a volume ledge, whether it's the wave, terrific. But I would definitely want to be long, not necessarily in front of earnings, but if there's a setup that triggers with the volatility of it, yeah, for sure. Yeah, for sure. Okay, let's see. Walter asks, I have a 500, 510 call spread on UNH. Thoughts about managing the gap down? Oh, yeah. Okay. Walter, I'm not going to be a lot of help here. And let me just preface this by saying what I've been trying to do for myself and for the traders in the rooms that I'm in is think way upstream. I know you're asking me about this particular setup. I don't have anything for you, my friend. I really don't. The best I can say is whatever high we made on the Wednesday candle, let's see if the Thursday candle can't take that high out. In other words, form a minor low, right? It's a classic pattern. Can we form a minor low? It's a very unusual minor low, or an inside candle. Can we form an inside candle? And even more basically, get above the volume ledge at about 455 and a half. Now you'll say, wrong. Pre-market, we're at 436. So what I would say is, at this point, we just manage sort of what we have. And we really want to see the minor low hold, which is basically 445.68. We want to see price from Main above 455 and a half. And we want to see price really start to accelerate north of yesterday's high at 460.63. If all those things can happen, that means there's definitely some seller's remorse and you might see a retracement. So what I would do is pull a retracement of the gap and see if we can't make a 50% at that point, or maybe even reach the volume ledge around 474 and a half. Okay, so those are all incremental things that we can measure with volume and price and a price pattern. That's what I'd say there. If you wouldn't mind, and thank you for asking, Walter, if you wouldn't mind, let me also go a little upstream, because in my mind, how do I prevent or at least reduce the likelihood of being caught up with something like this? Remember, a 510, 520 spread is really building a trade based on a certain amount of bullishness. And for me, when I'm in chop and I'm not able to see price establish itself above the 200 exponential moving average, and maybe even more specifically, the 500 psychological level, that 500 handle, if I can't see price establish, what I'm going to say upstream is I don't want to be putting myself in a position where I'm expecting overall strength, right? So if I'm looking for a place to be bullish, within XLV, just putting it out there, Walter, I would look at something like Lilly, right? Where is the trend favoring that path of least resistance? Or if I wanted to play something that's going to have a little bit more of a diluted effect across multiple stocks being weighted within it, I would put on that kind of spread in the XLV itself if you can find the liquidity, as opposed to an individual stock that's struggling to find the footing above the equator into the bullish hemisphere, meaning that 200, right? So overall, and Walter, the most obvious thing I would tell you is, what's the stop loss on the trade? What is your maximum permissible loss to your account, right? These are things, when I talk about the not so sexy subject of risk management, in a gap, obviously there's nothing we can do about that. So now we're just managing what we have and trying to reduce the overall loss to the account. But on the flip side of that is, when I'm putting on a trade, I also ask myself, what am I allowed to lose? Now, obviously a gap, especially of that size, throws that way out of the water, right? But I think upstream, if that makes sense, what I'd like to do is put you in a position where next time you're looking at a debit spread like that, you're asking yourself, gosh, do I have any real structure that suggests that there is a path of least resistance to the upside? So I hope in some way that helps. All right. Next up is ADM. So we're going to go right back to market structure. Tiago, if I'm looking at ADM, it is a downtrend. Path of least resistance, south, right? Below the 200. Yes, there might be moves to the upside. Yes, we might see overall days where we're rallying, but overall, the path of least resistance is to the downside. And the more that I can position myself at levels of resistance, the more that I can take advantage of bullish momentum and buying calls, which will be buying puts or selling calls into that, the better off I will be. So ultimately, this is a red structured market. The overall path of least resistance is down. It is the bullishness that's going to set the trade up. And we could say easily this trade most recently has been set up between Monday the 12th, Tuesday the 13th, and yesterday the 14th, as price climbed into the 34 EMA wave. Also, look at this Darvis level. If you're looking for something a little bit more singular rather than a zone, you have a Darvis level at 74.14. You've got a volume ledge at 74.14, and you've got a volume ledge up at 75.10. If you're looking for other types of levels where you can have a singular level and not a zone, look for where price, like Darvis, and automated support and resistance. This is Darvis 2.0. This is not traditional Darvis. This is a tweaked Darvis, right? Look at those zones. All right, Tesla. Overall uptrend, gang. Buy the dip. All right, so when I look at Tesla here, I'm going to be looking at about 249, 250 this morning. That's for the daily. Of course, we can day trade, right? So instead of the daily price movement ranges, as you can see here on the 60-minute as well, we might day trade this thing, right? We might look for the red zone of resistance, the green zone of support, and set up a trade. If we're looking specifically for a buy, I'll look for the green zone of volatility support to do it. As always, gang, thanks for joining me for Charts and Coffee. Caffeinate and dominate. I'll see you all tomorrow, same time, same station. Be good to each other.